This episode is brought to you by Persona. The best fintechs expand what's possible for users. Persona does that for fraud prevention. Their recently upgraded link analysis tool surfaces connections in real time, letting you spot deepfakes, identity farms, and fraud rings during onboarding and investigations. They just published their Fraud Leader's Guide to Link Analysis, a practical look at today's top risk signals, automating decisions, and scaling link analysis for fraud prevention. Download it now at withpersona.com/FTT-fraud. Hello, and welcome back to the Fintech Takes podcast. My name is Alex Johnson, and I am delighted to have another episode for you on open banking. As you know, open banking is a topic that I'm personally obsessed with, and that obsession became, I would say, a little unhealthy in 2025 when we had a lot of regulatory and market drama in open banking here in the US. Obviously, JP Morgan Chase initiated its gambit to get paid for its open banking data, a gambit that was ultimately successful. We had the CFPB flip-flop about 19 different times on the open banking rule that was created by the Biden administration. Supposedly, the CFPB under President Trump is working on a revised version of that rule, which we will see at some point. And one of the issues that's kind of the crux of all of this drama is this basic question of, should data providers be allowed to charge for access to data in open banking? That is a question that we have spent a lot of time and ink and digital airwaves discussing in the US. I certainly have contributed quite a bit to that discussion. But it's a discussion that shouldn't just be grounded in what's happening in the US. It should be grounded in what's happening globally, because this is a question that other markets have wrestled with, and in some cases have successfully wrestled with through regulation, through private market action, through market competition. And we have a lot to learn from markets like Australia, the UK, Brazil, Canada, and that's what I wanted to focus on in this episode. So I was delighted to be joined by Rafe Mazer of Fair Finance Consulting. Rafe is an expert on all things open banking, open finance, and in particular, the effect that open banking and open finance can have in different markets, in emerging markets, on improving consumers' access to fair financial services products. He recently published a paper, Who Pays for What? Pricing and Monetization Options in Open Finance. And it is a survey, essentially, of what other markets are doing, what pricing models exist, which pricing models other markets have tried and failed with, which pricing models are sort of emerging as the dominant forms of regulated open banking in other markets, and the effect that those different models have on market participants, banks, fintech companies, and most importantly, consumers. We cover a lot of ground in this episode talking about the reasons why it's probably a good idea that someone pays something in open banking, the ways in which the money raised by different participants is allocated across the market, and ultimately the sort of cultural and political economy differences in different markets that make it harder or easier to approach certain models. It was a great conversation. We covered a lot of ground. Rafe is going to be a recurring guest on this podcast because he had a lot of really great insights to share. So without further ado, here is my conversation with Rafe Mazer of Fair Finance Consulting. This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. Okay. Well, Rafe, thanks for coming on.
Thank you so much for having me. I'm a big fan, so it's nice to actually get to be on the pod.
I am delighted to have you on the pod. We've talked about doing this episode for a while, and I waited until now, partially because I was waiting for something to happen. I knew that you were doing a lot of research on open banking and open finance, and in particular, a piece of research that you were doing and working on that just came out in March is a report called Who Pays for What? Pricing and Monetization Options in Open Finance. We're going to drop a link to the paper in the show notes so that folks can read it. But I really wanted to have a conversation about the findings from this paper because while I've been all the way wrapped up around the axle with all things open banking in the US and everything that happened last year with JP Morgan Chase and Plaid and the CFPB and the Bank Policy Institute, so much so that I felt like I was in my own soap opera for a while there. It's important, I think, to recognize that the context of open banking and open finance, and even questions like who pays for what and how might we want to do pricing and like what's the best practice, these are not questions that we should or need to ask and answer in isolation just in the US, because, of course, open finance and open banking is a global phenomenon. In fact, it exists in many different regulated, semi-regulated, unregulated formats throughout the world, many of which I think are significantly further along and more mature and more advanced than what we have in the US, at least in some respects. And so I wanted to talk about this paper because I think it does a great job of sort of surveying a broader swath of the world and trying to sort of boil down almost from first principles, like, what do we mean when we say who pays for what? What are the costs that go into open finance? And what are the different models that exist for recouping those costs? What are the concerns? And then hopefully at the end of this discussion, we can sort of map all of those points onto what's happening in the US, and would love to get your thoughts on that as well. So let's start here. When a country decides to build an open finance system, and this can be sort of an organized effort driven by regulators, it can be a sort of unregulated market-driven thing, which is what has kind of happened in the US. The question is, who pays for it? You had four sort of categories of costs that you identified in your paper. Can you walk us through those? Because that was the first time I'd ever seen someone sort of break it out that way.
Yeah, I'd be happy to. And I think the key thing that's different in this policy space than much of financial regulations, we're building something. You're creating an infrastructure that you want to be sustainable over time, not just setting rules you would enforce. And so it helps to have this longer term view. And so the first stage of costs, of course, is the initial building of open finance. And that's setting the rules, but also setting the API standards. And in many markets, creating a centralized technology infrastructure, which I think is a little different than in the US, that will actually run the connections. In some countries, it even does consent management centrally. So it can be quite a complex thing to build and to get up and running with hundreds of participants. That's where you see the biggest costs. But then the journey is not over then. You now need to fund the technology and the infrastructure for the day-to-day transactions. And you look at some markets like Brazil, where they're doing billions of API calls per month. And so it's not an insignificant thing to fund and make sure that the system is functioning well and that the APIs are meeting a certain threshold of performance, the data is of high quality. And that is also where the maintenance costs get into, where, any technology system, there's constantly needs to update and patch and things of that nature. And that's both the participants and then whoever's running this centralized infrastructure. But what I think is most exciting about open finance is the version we're seeing right now is not the version you will see in 2 or 3 years. It can really adapt and grow with financial innovation. And so that's where you need to think about, do I have a system where we're bringing in sustainable revenues that will support expanding from just banking and payments to insurance, to investments, or bringing in new use cases in payments like variable recurring payments, things of that nature. So it's building, transacting, maintaining, and expanding is how I like to think of it. And just as I mentioned, the upfront costs are usually we have the biggest expense. And what's also interesting is who is paying for it kind of changes over time. The costs get more democratized, ideally. As more entrants come in, you start to not just make the big banks pay.
Interesting. Okay, so let's talk about what some of those different models are, because again, as you outlined in your answer, there's lots of different markets where this works very differently. Like your description of centralized infrastructure is so different than how we think about it in the US, right? We think about it as, well, Plaid built their sort of network of integrations, and MX built theirs, and Finicity built theirs, and now here comes Akoya, and it's like a privately absorbed cost on the part of all of those aggregators, which is very different. I mean, I think the parallel in the US that's probably the closest to what you're describing in a lot of other countries with centralized infrastructure is more the way that like the Federal Reserve sets up payment infrastructure in the US, right? Which is to say, like, hey, we want you to be a member of the Federal Reserve. This was a problem in the 70s and 80s in the US. Banks were sort of opting out of being a part of the Federal Reserve. We want you to be a part of the Federal Reserve System. So we're going to build this electronic payment system. And legally, we have to recoup our costs. So the costs are maybe a little higher at the start, at least that this is the sort of analog experience in the US. And then over time, the costs get lower and lower because it just becomes sort of a utility for the market that sort of operates. Obviously, we did that with payments. We did not do that with data, but other markets, it sounds like, have. So walk us through the 5 sort of like models for who pays that you sort of discovered when you were looking at systems in different markets. I was sort of thinking them a little bit as like sitting on a continuum or a spectrum in terms of kind of where they fit. So walk us through kind of that spectrum, the different models and where they fit, and then let's kind of dive into each of them in a little bit, because I think they're really interesting.
Absolutely. Yeah. So the first one, probably the simplest, is as you would have in the US, where like financial data exchange and others do not intervene on commercial terms. And so you just have the market determines what one entity will pay the other for the API call and the data exchange. Then I like to think of next the one that's the complete other spectrum, which is where you don't allow any charging for these data exchange APIs. And that's basically the idea that a consumer has a right to their financial data for free. Then there's 3 others, which I think are the really interesting ones, where you're starting to try and account for the costs, but in a more regulated way. And the first is threshold pricing, where you will say, okay, below a certain number of API calls per account, per day, per month, whatever the horizon is, or a certain total usage, it's going to be free. But then when you go above that, there's an amount that will be charged. Either it's set in the regulation or it's left to the market that you can start to charge. So that helps smaller entities enter the market. Then in some markets, they're doing what's called premium APIs, where you have a certain core set of APIs that are free, usually basic consumer data in the regulation. And then other things like analytics services, additional data, you can charge for that. And then the last one is when you have these centralized infrastructures, sometimes they will set fixed prices with the goal of just cost recovery for the shared centralized infrastructure that runs open finance, and not trying to create a profit margin for any participant, but just to fund the common infrastructure. So those are the 5 main archetypes, and they're not mutually exclusive. You see blends in some markets.
Okay, that's really interesting. So to sort of put it on a spectrum, I would think of it as on the one end, as you said, like, hey, this is going to be free. It's a consumer. This is where you tend to hear consumer rights language sort of creep into this discussion, which is really interesting in and of itself, because like separating the question of how should something work from how well will something work depending on models is sort of an interesting difference, right? So sometimes the rights language, I find, sort of obscures the question of like, yes, but what's going to make the system work the best? So if we just sort of ground ourselves in this, this rights question, which we've flirted with in the U.S., that was what the rule that the Biden CFPB came out with was this will be free. You can't charge for it. I think that CFPB felt they were on pretty solid ground legally to make that case. Is Australia another example of one that took this approach originally? Am I remembering that right from your report?
Yeah, they would be one of the main examples. And everything is still free there currently, but they have introduced reforms to their system because theirs was enacted under a broader consumer data right that's across the whole economy. and
Right.
it will include utilities. It will include, telecoms data eventually. But they started with everything is free, but they are now developing the rules to introduce these premium APIs. I think they've recognized, you also see a similar process happening in the United Kingdom, that in the long run, to incentivize market participation and innovation, you may have to create some economic incentives. And I like this also as a way to cross subsidize. So yeah, Australia is the primary of the it should be free model, but I think they're even adjusting that now.
Right. Right. So the recognition, it seems like in Australia, and then you reference the UK as another example of this, is that if you don't provide some way for this to be seen as an investment on the part of the companies that are providing the data, that you don't tend to get like really just like prioritization, right? I mean, I think about this a lot of times from the perspective of having sold to big banks a lot over the years. Like there's a huge difference between yes, we'll do this when we can get around to it versus yes, this is a priority. And even, it's funny, I think regulators sometimes don't fully appreciate this. Incentive alignment is so important because like, and I've told this story before on the podcast, but like it this can be a very sort of emotional issue that sort of crosses over from like logic and sort of reason into like, no, I hate this. This is my data and I'm not going to share it. And you see some examples of this in the US, and I'm sure it's existed in other markets too, where it's like, these data providers, they can rub sand in the gears in subtle ways and just sort of degrade the system if they don't like it and drag their heels. And obviously in the US, we've seen a whole flurry of lawsuits. Like if you're not incentivized to play nicely in this space, it can be very difficult. So it sounds like if we move in on the spectrum a little bit, the idea of premium APIs is this idea that, okay, you have to provide this baseline level for free, but we're going to create a competitive tier above this where you can offer services, you can make money, you can do these things. Actually, ironically, in the US, this isn't a perfect analog, but Block is getting ready to launch their own credit score that they built on top of like Block cash flow data for Cash App and Afterpay and the services they provide. So like you can create this higher layer. Maybe an analogy would be something like, okay, the credit bureau, the credit file needs to be free, but you can sell a credit score on top of that credit file, or you can sell utility data or income verification data that's a little outside the core credit file. So premium is a way to sort of entice that sort of market participation. Talk a little bit about the fixed costs to pay for recovering infrastructure. I'm guessing, I think it was maybe South Korea. Yep. That's a good example of this. I'm assuming that they're a market where the government is operating that centralized infrastructure and it's cost recovery for them and for all the participants that are taking advantage of it. Is that how it works?
Well, what's surprising and kind of remarkable in South Korea is open banking is not regulated. It was established by the KFTC, an industry entity, and they run this exchange. And they have built this system on a voluntary basis that has wide banking and fintech participation with these fixed prices that they update every 3 years based on their assessment of the shared infrastructure costs. And it even has dimensions like, in some cases up to a 50% discount per API call for small fintech institutions. And it's, to me, I think that speaks perhaps to some political economy aspects of South Korea. And I think that's another aspect of this that that really influences your pricing policy is the political economy of your country and the market structure of your financial sector. Like in Africa, where I mainly work, you have incredibly concentrated mobile money payments markets where one entity will have 95% of market share. And that's a situation where it's going to be hard to get kind of this consensus like in South Korea, but they have somehow through a voluntary mechanism established this with these pricing rules. India similarly will be probably setting pricing rules through a self-regulatory organization that started as a nonprofit called Sahamati. I think where that can work is if that standard setting body, that private body, has been successful enough to become kind of the only game in town for these types of services, right? Similar to, I think, what we thought FTX would be if, the 1033 rules hadn't been vacated.
Yeah, no, it's interesting, right? Because like I think a lot about like what's an alternate path for these things. A lot of these are like path dependent things, right? Where it's like, oh, because this happened and then this happened, and because our market structure is this way, and because these banks didn't view this as a competitive threat for whatever reason, like there's a chain of like if that ends in a place where you have this strong sort of independent organization that can set rules and that everyone agrees to play by them. But like, again, to use a US parallel, like imagine Akoya coming out now and being like, yeah, we're going to be the standard for all of this. And like, everyone's going to play. Like fintech companies would be no way. And obviously like Plaid and those guys would think that that's like not even a realistic option. So you're right. I think it does speak to the political economy of specific countries in a lot of ways in terms of that model. The other one, and you've already referenced this when talking about that one as well with discounts for like cheaper providers, is this threshold pricing idea. And I guess my read of this, and you tell me where you disagree, is that this is like one of those concepts that maybe sounds a little bit better on paper than it works in practice. And the theory is, right, we want to make this easy for market participants who are just getting into the market to not get priced out of using these. And there's like a ramp up period where you can build your product and it's not too expensive as an input. But one of the things I've seen in the US is that there actually is oftentimes a level of regret that providers have when they build like open banking or open data or something like this into the center of their product in a way that's hard to rip it out. Because when costs go up, and it could be because you hit a threshold, or it could be because commercial terms change or whatever, when the price goes up, it can really screw with like the unit economics of your business, right? Because it's like, hey, this is an input into this product that we provide, and the cost of that input just went up. It's not unlike tariffs where it's like the cost of steel just went up. Like now the thing I sell doesn't make any sense. And so I wonder how successful that's been. Where in the world were they trying this, and what's been the result?
So I think with threshold pricing, the biggest determinant of its success or not so far is, do you have centralized API exchanges? Because Brazil put this in their regulations, and where there was a certain free number of calls per month per each account in open finance. And after that, there were charges that could be established that weren't set in the regulation. They were to be determined. But they have never enacted that. And none of the participants have billed each other, because Brazil does bilateral API exchanges, and the accounting was just so much work and effort. It wasn't worth it to try and set up these billing systems when you have 800 plus participants, and to then do your accounting with all of them in a decentralized manner. And a lot of the bigger actors, the large banks and then the large neobanks like Nubank and those, they're all big consumers of this in both directions. And so it was kind of ending up being a wash for a lot of them, the actual net revenue or debit they would have to others in the system, right? Because if you think about someone calls the APIs for, myself 100,000 times, and I do 110,000 calls to them. It's not that big a difference, and it's almost not worth collecting it. The UAE is still early, but they have a centralized infrastructure and does have some threshold pricing built in. And I think it could work in a place like that where the government has spun off this LLC out of the central bank that does all the APIs. So they can just do the accounting internally.
Yeah, that makes sense. I mean, Brazil is one I wanted to talk about actually, because this idea that all of the participants are sort of roughly equal with each other in terms of like data given out versus data taken back in. That's the other thing that in the US, I think we're not fully wrestling with a bit is, historically, open banking, and I imagine this is true in other markets as well, like open banking or open finance was seen as the tool of the disruptor to take market share away from incumbents. In Brazil, obviously, you have Nubank, you have a number of other very large providers that have taken quite a bit of market share already. I think I've even seen like bank executives in the US sort of cite Brazil as like a nightmare that they worry about in terms of like the effect of disruption over time on their sort of market share. Is it healthier for a sort of open finance ecosystem to have more balance between like data providers and data receivers? Because I feel like that's one of the things that I see, at least in the US, as a challenge to regulating this market, is that when you pick rules, there are very sort of easily defined winners and losers depending on how the rules come down, because someone's giving out more data than they're taking in. Someone's taking in a lot more data than they give out. And so if you preference one side over the other, in effect, and I've talked to a lot of regulators about this at the CFPB over the years when they were trying to wrestle with some of these questions, they really didn't want to pick winners and losers more than they had to. But the structure of the way that open finance data was used to a degree had that effect in practical terms, whereas it sounds like in Brazil and maybe other markets that has been less the case. How do you view like that balance or lack thereof affecting sort of the regulatory posture?
So I think that the way that it has worked in markets like Brazil, where you've had most of the participants feeling like they've won in the end, is one, they built a highly effective system that really has added a lot of value, because there were a lot of under sort of thin file consumers in Brazil where there just was not enough shared data. And you all have risk when someone's borrowing from Peter to pay Paul and you don't know about the loan to Paul and your peer, then you run into trouble. So it solved the collective information asymmetry problem, but they also put in good rules like reciprocity. You can't be just a data collector in Brazil. If you have that category of data, then you have to have APIs that can send it out. So if I'm, Banco do Brasil, I have to share a lot of data because I'm a large bank, but also I will now have access to new banks' data. So the reciprocity part was good. And I think another thing related to their policy and how it impacted pricing, or not, this fact that their pricing model maybe wasn't the best, wasn't a deal breaker, is they have diversified the funding for the shared infrastructure over time. So originally the banks paid a lot, but pretty quickly they made large actors like new banks start to contribute more, and they reduced the maximum that any bank could pay to fund Open Finance Brazil, which is the governance body. So I think that's some of the ways that Brazil was able to handle this even with a suboptimal pricing regime.
This episode is brought to you by Persona. Fraudsters test your defenses until they find an opening. Then they attack. That's why link analysis tools like Persona's Graph are so important. They let you find users who share attributes like IP addresses, device fingerprints, or any other signal that your risk team might want to define. From there, you can shut down entire fraud rings and add link analysis checks directly into onboarding, so repeat attacks and copycats don't get a second shot. Learn more about how link analysis works and what makes Persona's real-time graph unique at withpersona.com/FTT-fraud. That's fascinating. Yeah, I mean, the parallel that I would draw, and I think we have screwed this up tremendously in the US, the reciprocity thing is such a good point, because I think a lot of the flaws that are sort of starting to express themselves in the US market come from a lack of reciprocity, right? Where it's like, use the credit bureaus as an example. The credit bureaus for a long time had this sort of informal rule that if you bought data, you had to contribute data. And at some point, they let go of the rope on that, right? And it's because they're private companies and they're all competing with each other for market share. And so in comes Fintech, and Fintech becomes this big user of data. So they want to buy data, but they don't really want to provide data. They sort of make the argument that like oh, Metro 2 and the technical standards are like kind of unfun to deal with, and we don't want to like furnish data and blah, blah, blah. And the credit bureaus sort of let it slide. And I think where that has sort of ended up is, now in the US, there's very unequal pots of data sitting around where like there's a strong incentive to buy but not to share. There's a lot of people, even from like an open banking perspective, and this is like quietly a thing that fintech would prefer that you not know in the US, but like a lot of fintech companies use open banking very aggressively to get data and then don't share nicely. They don't provide data back. And so I think reciprocity, like it's a simple concept, but it does have that effect of kind of balancing out the market. Based on all of these different models we've been discussing, these 5 pricing models, which one do you think is the best sort of pricing regime, or the one that seems to be getting the most momentum globally?
So I think that more than any one, I'm being drawn to some blended models that I think are only really possible with a centralized infrastructure. So that's where South Korea or United Arab Emirates, some of the other Middle Eastern ones are really appealing to me, because I see how having that centralized infrastructure and the record keeping allows them to be adaptive to what the market needs, right? That South Korea can create a window for some smaller fintechs to get preferential pricing, but they're going to graduate out of that. The UAE can say the first 15 pages of API call are free, and then after that, they actually let the market set their own pricing. And these ones also have different membership rates for larger, smaller entities. So I think it's, just to sum up, it's probably a centralized infrastructure that has its main principle is cost recovery, right? That's really about funding that. And that is being creative in cross subsidization of, free and premium APIs, temporary discounts for new entrants or new use cases. That's kind of my ideal model, basically.
Mm-hmm. That makes sense. And it solves a couple different problems, right? Because one of the ones that you mentioned earlier is just the sort of accounting and ledger sort of problem of like, hey, if this is all kind of bilateral, but they have to operate by a set of rules, will they want to take on the cost or the expense of doing that? I also think just from, and I know you've probably talked to regulators and central bankers in a lot of these different markets. I even think stuff like monitoring the health of the market is a lot easier when it's your pipes that all of this stuff is going through, and the ability to like assess risk and like look for evidence of bad behavior. Like you own the network, so you can sort of monitor compliance with the rules and sort of make sure that it's working the way you expect. I wanted to ask you about sort of pricing and its impact on different business models or different use cases, because you had a quote actually in your paper, I think this is in relation to India. It was saying 1 rupee per data pull works well for a lender, but it breaks the personal financial management model. And I thought that was a great like quote and a great way of describing a challenge that I see in the US too, right? We're going to get to Chase in a minute, but like just to preview that, I think it's fairly clear that an objective they had with their pricing was to sort of kill pay by bank as a model in the US, right? Because like they have a debit card business and they've, kicked the tires on pay by bank, and they even do a little pay by bank, but they don't want pay by bank to become the way that you pay for stuff online, because that significantly disrupts their credit card business and in particular their debit card business. And I think it's an interesting example to sort of apply broadly, because, I talk to people who do cash flow underwriting all the time using bank transaction data. And I asked them about, JP Morgan Chase raising prices, and they're like, nah, it's nothing to us. Like, we have a lot of margin to play with. Making a credit decision is a super valuable decision to get right. If we can reduce risk by 30%, like that pays for a lot. And, have you seen how much we pay for a credit file when we're underwriting a mortgage? Like, it's expensive, right? So there's lots of margin to play with in certain use cases, but in pay by bank, there's zero margin. And as that In other markets, like personal financial management would fit into that category. So what do you think about the relationship between pricing and use cases, and how much regulators need to be involved to like protect certain use cases that might be beneficial for market competition, but aren't necessarily ones that will be viable if the market just has full control over the pricing?
Yeah, I think it's the hardest decision you have in the range of pricing policy considerations, because you're making a judgment in the market if you decide to intervene that this product is worth more than the financial viability would say. And
Right.
I think the products kind of have to prove that. It was not just in India, but in the UK and several other markets, this personal financial management case kept coming up. And some people were saying, look, it's been 4 or 5 years. If that has not proven itself as a commercially viable product, then why do we want to keep pretending? And so I think that to me is the challenge of a policymaker. I think there's a certain window of time you maybe want to allow for that, but then you may have to reflect and wonder, is this really something that's worth preserving its right in the market? But then, as I mentioned before, you do have some tools where you can look at cross subsidization, like South Korea again has different pricing for API calls of different data, somewhat based on its market value, which is interesting to me. So some of the credit relevant data has a higher API fee than some more basic data, and so that's one other way you could look at it. But that gets into a challenging policy space, because you're both saying you don't want to let the market assign the market value to data, but then you're saying as a regulator, I am going to assign relative market value to this data in my price regulations.
Yeah, that's a great way of describing it. And to use PFM as an example to maybe just sort of expand on that a little bit, it's also hard because sometimes it's just not the right time in the market for a solution, but it doesn't mean that that solution won't be viable over time. I just wrote about personal financial management, which is a category of fintech I'm obsessed with personally, mostly because it hasn't worked, to your point, for decades, right? Like it does not work, it does not work, it does not work. Founders keep going back and trying to build it. But I also think like maybe we didn't have LLMs and agentic AI, and now we do. And maybe PFM suddenly works in a way that it wouldn't have before and is a commercially viable product for the mass market, but it does need data to run. And so like there's these questions about timing where it's like this product didn't work, now it does. To your point, like this other product has more value, so we can maybe charge more for it here. You see this in the credit bureau space. A credit file or a credit score for mortgage costs you 10, 20x what it costs to do a different lending product. It's the same data, it's the same score, but they charge for it differently based on the value. And so the private market tends to find those equilibrium points, but having policymakers step in and assign a value to it is hard. The other thing I wanted to ask you about, Rafe, is the US is just terrible in so many different ways. But one of the ways that it's uniquely terrible and challenging with this kind of stuff is we have 200 different regulatory agencies that all fight with each other over this stuff, right? And so to use an example, like why is income verification in mortgage a really valuable use case for data providers? Well, it's because we have Fannie and Freddie who buy all of the mortgages, and they require verified income as a part of any conforming mortgage that they buy. That is a regulatory requirement set by one regulatory agency that then creates a market for a different part of the data provider ecosystem that is regulated by a different regulator, right? And so we tend to have this a lot where different regulatory agencies work at cross purposes from each other. And this actually came up a lot in open banking as well, where you had Rohit Chopra at the CFPB who was talking about, we want to make it easy for you to break up with your bank. You'll be able to move checking accounts from one provider to another, just like switching your mobile phone service provider. And as he was describing this sort of competitive utopia, in my head, I was thinking, gosh, like the OCC, the FDIC, the Fed, like the regulators responsible for safety and soundness of the financial system, like they're not going to like anything you just described because it makes the
Mhm.
banking system less stable, more competitive, but less stable. And stability is their job. They don't really care about competition. And so I'm curious how, if at all, this tension manifests in other markets, or what the effect of this sort of tension between regulators in a market is. Because my sense, looking at other markets, is at least in some cases, they have a more unified regulatory structure. And it feels like that allows them to sort of weigh the pros and the cons when they're coming up with rules, rather than like, I'm going to set this rule and then this other regulator is going to come in here and kind of change a different part of the market. How does that play out in other markets?
Yeah, I think the US is such an outlier that it really does make it much more challenging to follow a lot of these models that I'm talking about. Because the majority of the countries that I work with, there's either
Mm-hmm.
a really prominent lead financial regulator like a central bank, or there's a Twin Peaks model. In some of these markets, you do also have like a microfinance regulator or a credit cooperatives or rural banks regulator
Sure.
that handle segments of the market that probably will be later to join open finance just because their technology is not really up to creating this secure set of APIs. So I think it's a really uniquely US challenge, and it's where I'm not sure what can be done about it. The one thing I would say is that on this stability risk about account switching, actually, in the original open banking in the UK, this
Yeah.
idea of porting your account was one of the lead use cases they put
They were
into
very
open
big on
banking.
it because they
And it,
were very focused on competition. Like
yeah,
competition was a huge mandate in the UK. Yeah.
and it didn't really get uptake, right? All the other things, the payment initiation, the data sharing to get new services, that's all, doing great in the UK and Brazil
Mm-hmm.
and other markets. But that was not a real consumer need, and it's actually a fairly complicated thing. So it's not being included as a use case in many of uh, the new open finance models you're seeing in Africa or Asia. And what I've found working in Africa with banking customers is people don't transfer bank accounts. If they don't like one bank, they just let that account go dormant and get a new one. And so I think that perhaps that would assuage some of those concerns about stability risks. But yeah, I'm not sure what advice to give the U.S. compared to other markets because it is just such a sclerotic regulatory environment.
It is. It is. Yeah. I mean, that's even probably too nice a phrase, strangely, to use to describe the chaos that we have here that we have to kind of design around. Another thing that you mentioned earlier on that I wanted to circle back on real quick is this idea that pricing models in a market tend to evolve over time, right? So, like, it might start as one and kind of evolve over time into another, and that some of the choices that you make early on, whether you know you're making the choice explicitly or you sort of make it implicitly, sort of set the bounds of what's possible later. Can you elaborate on that a little bit in terms of like what early design choices impact how pricing may evolve as the market evolves as well?
Yeah, I think the main thing is you want your powers to be firm but flexible. And one of the challenges, if you look at a case like Brazil, that threshold pricing model is in the regulations. So you're going to have to
Right.
adapt the regulations. Whereas I think when you give general powers early on for the authority to set pricing or to enforce pricing when they see anti-competitive practices, and then you have the actual pricing rules themselves, something that either the implementing body implements or are updated periodically in an annex, you just have more flexibility. And one of the models that I liked in my paper that I thought was quite clever, kind of from a policy design, is in Oman, where they have started with letting the industry set pricing, but each participant has to present their pricing and commercialization strategy to the central bank. So it's very transparently presented to the regulator, and the regulator has the power to establish pricing rules if they choose to. So it's sort of saying, if you all can figure out a way to play nice, then we won't have to intervene. But we want to closely monitor your strategies and your actual pricing, and then we can set rules later if we need to. Another thing I think that is a good example is the UK is doing a nice job now where the regulator and the industry have done this really expansive analysis and consultation process to introduce the first chargeable activity, commercial variable variable recurring payments. And I think that's a great example where it's each entity has developed their paper on their suggested pricing model, and now they're reviewing together, and they're going to determine a joint pricing schedule this year. So it's not the regulator coming in up front; it's working with the industry to set standards.
Yeah, I really like that idea. Let's talk a little bit about the U.S. now, because that's a perfect lead-in. I mean, the firm but flexible, I think, is such an interesting phrase, and it's one that I really like. It's funny because in the U.S., because of the way we've sort of dismantled administrative law over the last couple of years, it really strips away a lot of the deference from regulators, even when it's given to them by the law, right? Where it's like, unless the law is incredibly prescriptive about you can do exactly these things, regulators' hands are now much more tied than they used to be, and they can be sued. I don't know how common lawsuits from industry participants against their regulators are in other markets. Obviously, in the US, it's very, very common and something that you have to sort of preemptively plan for. But, it's interesting. You talked about Oman as sort of an interesting sort of counterexample where they're letting the market figure it out first, but with transparency. I guess that would be one of my main critiques of what's now happening in the US is, to a degree, I'm actually okay with commercial realities sort of setting some of the priorities here, right? Because, the market in the US is hyper competitive. It's very large. There's constantly well-funded challengers coming into the market to try to take away market share. And so I actually feel relatively confident in the sort of competitive powers of the US market. And in some ways, I think that cuts against some of the objectives that the Biden CFPB had in setting the way they set the open banking rules. Is they sort of looked at the market and were like, it's not competitive enough. And I actually don't necessarily feel that way. Like, I think one of the few things that makes the US a good market in this discussion is it is hyper competitive. The problem is that it's not transparent at all, right? And to use Chase as the example, we know based on reporting that they've come to terms with most of the large data aggregators that cover most of the volume for the data going out that they send out. But we don't know what those bilateral agreements are. We don't know what the terms are. We don't know if Chase is discriminating against certain providers more so than others, right? Based on, I don't know, the competitive threat that they pose or what have you. Like, we don't know any of that, to say nothing of the fact that Chase has gotten all of the sort of press attention because they came out and did this in a very public manner, which I think was tactically a mistake on their part. But, I think we would be foolish to assume there aren't other large entities moving silently under the water also negotiating these agreements, and we just might not know about them. And more to the point, regulators might not know. Like, they might not have any idea what's happening. And so it makes it very difficult to sort of assess what's happening in the market and understand the competitive dynamics. How would you sort of critique where we've landed, again, not by design, but sort of by accident in the US? And if you could sort of prescribe some improvements or some ways that we could kind of nudge ourselves to a better model, what would some of those nudges be?
Yeah. And so I will start by saying, like you, I agree, we have a very competitive environment. And I do think it's pretty remarkable what Financial Data Exchange achieved on a voluntary basis.
Totally.
The US was one of the first open banking markets. It was a private model, but it was one of the first to get a significant scale. But I do, in this challenging regulatory environment, get back to transparency, as you mentioned, as one of the main things that I think could drive some market pressure to reduce the costs for these types of data exchanges, because I've seen it in other markets when you implement a pricing transparency rule. And this happened with credit card providers in a Latin American country. And all of a sudden, about a month before the new rule, which is going to have all-in, APR pricing, and they were going to publish it every month, what each credit card company charges, all of a sudden the market's rates dropped significantly. It all moved in mass right before the regulation. So I think transparency can sometimes create a pressure. And I also think it aligns with some of what we're asking for. I work globally, but I live locally. And as a customer, I am fed up with the hidden fees and the add-on charges when I try to go to a basketball game with my kid. And we've seen some enforcement of that. So I think in this space, all-in transparent pricing that breaks down if you're charging the consumer extra, for this data aggregator to do a call at your bank on the customer's own data is the least we could do for American consumers.
Yeah, I agree. And I also think, to add on to that, and this is a comment that applies to the data aggregators, it applies to the credit bureaus. Like, I'd like to see more transparency from them as well, too, right? Like, you hear when you talk to people who are builders in this space, they'll talk about like, oh yeah, I had no idea when I was negotiating with all the data aggregators, like which ones to use. And you could make the argument that, is it really fair that we have to like publish our pricing or share our pricing, or like, at least, let regulators know what our pricing is. And I do think that it is actually fair, right? Because, to go back to an analogy I used earlier in our discussion, to me, data is the new payments in a lot of ways, right? Like in the 70s and 80s, we sort of recognized, at least in the US, that like payments was going to become a sort of large part of the electronic payments were going to become a large part of the financial services ecosystem. And we needed to have some base level infrastructure that sort of level set the competitive ecosystem for everyone. And not that you can't build value added things on top of it, but there needs to be a baseline understanding of like how this is going to work. I also think another thing we haven't spent a lot of time talking about, but I think, I'd be curious if there's examples of this in other markets. Maybe Australia is a good example with some of the data privacy stuff that they've been doing. But like, I'd also like to see more explicit consumer rights spelled out about a lot of this stuff, right? Like I think we sometimes run into this issue where, like in payments, I think one of the things that makes payments work so well, even with kind of old technology that we're still kind of wrestling with, is like we have Reg E and like really explicit regulations for what a consumer's rights are when dealing with payments. And does anyone in the payments ecosystem like Reg E? No, it's a huge annoyance to them, blah, blah, blah. But it sort of sets a common like set of rules and understanding. And it feels like, not only are we seeing like a lack of transparency in pricing, but we're just sort of like letting the market determine, well, we think this is fair to customers. Well, we think this is fair to customers. Like everyone's just kind of setting their own rules. And even if you don't have a comprehensive open banking regulation, like what the Biden administration tried to do, and now what I guess we might get out of the Trump 2.0 CFPB, although I will withhold my judgment until I actually see something get produced by the agency in terms of a new rule. It just feels like in the absence of all of that, there's too much just we'll let the market figure this out with very little transparency or looks on consumer rights. So I guess to close out, like, where do you see the US market evolving? And then like, do you see like the future becoming more diverged between sort of the chaos we're dealing with versus what other markets are kind of doing in a more sort of structured approach?
So before I get into where it may evolve, I think one of the fundamental things we're dealing with in the US that is much more challenging is, compared to all these other markets I've talked about, have a data protection law.
Right. I'm glad you mentioned that.
We seem to be immune to protecting consumers' data rights in the US because of how captured our elected officials are by big tech donations. And that makes it really challenging because you don't have some underlying rights for consumers around the security, safety, and control over their data. And I think that a lot of that is enabling to open finance legislation. You don't have to have it. Australia didn't have their data protection law when they launched open banking. They had an outdated one, but it does enable it, and it also, I think, puts a check on some of the more exploitative data business models and financial services that exist. And I think that's another problem, is you can really get away with a lot of this because there's this legal vacuum around data rights that consumers or through class action you could exert regarding how your financial data is used.
We really only have like the FCRA in the US. Like that's it. And it's so narrow compared to how data is used today. Yeah.
Yeah. And then, states have tried to put in laws. There's actually been some interesting analysis, positive impacts of California's data protection law, its data portability provision. There was a really fascinating study where a fintech used that provision, and they tested consumers who opted in for additional data sharing or who didn't opt in when seeking a loan. And they were able to give lower cost loans, and they served more zip codes with lower income populations. So they were able to serve underserved consumers in California through the data portability requirements just of the Data Protection Act, not even Open Finance Act.
Interesting. Yeah.
And so I think that's where it can have some catalytic power. But I am like you, when I look at the future, I do wonder, will some of these LLM solutions help us as consumers? And will they be able to, if you at least have mandatory access, be able to figure out really efficient business models that start to help you allocate your money to a financial service provider that actually has your interests at heart? So that's where I'm sort of optimistic for more empowered personal management just through the power of those. I do hope. I think there is a public sentiment towards greater consumer rights in the technology space that I hope will cascade, maybe not in this administration, but in the next, into a more robust open finance law.
Yeah, I mean, it was one small statute in a very, very large law the last time we tried. And so I think an optimistic note to end on might be something like, especially with AI and LLMs and the idea that scraping data is not hard now, right? Like we can spin up scrapers like that now. That bottoms up pressure, along with, as you said, this kind of cascading idea of consumer rights from a technology and a data perspective. It would be nice if those came together in the form of modern legislation, and for all of the challenges we have in the US, I do think that a benefit is it's a hyper-competitive market where stuff evolves so fast. And usually the pattern is it has to evolve so fast that it breaks something pretty fundamental. And then we go in with legislation and clean it up. And then there's a will to pass a law to do that. But I see us hurtling towards some version of that in the not too distant future, because it just feels like what we have is not going to be sustainable. And in particular, in an increasingly global environment, it may not be competitive, right? I've joked about this in my newsletter that I owe my Canadian listeners and subscribers an apology, because they've leapt ahead of the US now when they're doing some open banking and open finance stuff. Australia's evolving, Brazil, the UK, India, the UAE, Oman. So it's happening everywhere. And I do think that the US, from a regulated open banking and open finance perspective, is going to have to catch up whether we want to or not, but might take a couple more years and a couple more things breaking. Rafe, I could do this for another hour easily. Thank you so much for coming on the podcast. This was great. Like I said, I will drop a link to the paper and where folks can find more information on the work that you're doing. It really is spectacular and very first principles, looking across the whole world to figure out what's going on. So thanks for coming on and sharing some insights with us.
Thank you so very much for having me. Yeah, and I'm happy to connect with any of the listeners if they want to learn more.
Awesome. Thank you. Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.